my fault. So all of this is my fault. For those of you who've been here on earlier occasions, you will no doubt recall that I sit at the front and try and look enthusiastic, or stand at the front and try and look enthusiastic and say, well, there's not that much in the budget, but then talk very quickly for sort of half an hour, and everyone goes on their way. And secretly, in my heart, I've been hoping for a real blockbuster. And while my grandmother, God rest her soul, was alive, she said that there were more tears shed over prayers that were answered instead of prayers that were ignored. And that is very much the case this time, because it is an absolute blockbuster. The Chancellor raised £40 billion through tax rises yesterday, which is more than Norman Lamont in 1993, and indeed more than Dennis Healey in 1974. And if you perhaps had a glass of wine late last night doing the budget slides, you might picture Rachel Reeves, Dennis Healey, and Norman Lamont reenacting the Four Yorkshiremen sketch from Monty Python, saying, you know, when I got to be Chancellor, there were £22 billion black hole, £22 billion, you were lucky. But anyway, was it really a surprise? Because was the black hole really a surprise? Successive, the OBR has been making charts like this since 2016. This is the most passive-aggressive chart in government. This shows the government's announced fuel policy every year, followed by what actually happens. So every government since 2010, although to be fair, those have all been Conservative governments, have been promising to increase fuel duty rate and basing their spending plans on that. And every year it's been deferred by another year. And that is we're now 14 consecutive years of surprising fuel duty reductions. So was it really a black hole? Dennis Healey in 1974, when he was challenged by a member of his own party that his tax rises would lose in the next election, said, "That is what our policy is. The party must face the reality of it." So there we go. Personal tax. The big one, one of the big ones, not the biggest in terms of numbers, but the most complicated. This was announced in March 2024 by the Conservatives, where they stole Labour's policy on non-domiciles and then spent the money on a tax cut in the most obvious political trap you can possibly imagine, the sort of political version of digging a hole in the forest and covering it with leaves. The proposal is to abolish the concept of domicile from a tax perspective, and indeed the remittance basis from 6th of April 2025. Rachel Reeves did give the impression that some of the nastier bits of the policy would be watered down. She promised to create, and I quote, an internationally competitive system. I can now confirm that we did not get any watering down, really, or any significant watering down, and we have not created an internationally competitive system. I was talking to a client earlier this week who is a banker based abroad, and he said 4 years isn't enough. 4 years is not enough. People will not come to the UK just for 4 years. They've got kids. They don't want to uproot them every few years. There is a reason why most countries who are seeking to attract rich people to their jurisdiction give 10 years, but there we are. So what does this mean? So the remittance basis, the rule which says that if you're a new resident in the UK, you're only taxed in the first few years on income you bring to the UK for the first 15 years, will be abolished and replaced by a 4-year full exemption. So it's a stronger tax relief, a much better tax relief, because you don't have to leave money abroad, but it only lasts for 4 years rather than 15. We were a bit worried at Saffery. We've got a big international tax group, and we were a little bit worried that post-April 2025, when this comes in, would there be that much for them to do? We were worried about reskilling, and this is an absolute monster. The exact number of pages of legislation seemed to change every time I looked at it last night, usually as I was getting later and later, but there's definitely over 100 pages of legislation, and it is a brute. It took me 2 hours yesterday to read the technical note, and I still don't understand all of it. It is a monster. So we'll be hiring. So the big winners to this are Saffery's international tax team. I'm very grateful to the boffins of the international tax team for helping me yesterday. We don't let them out much. They're certainly not all here. They're the sort of Q branch of our tax team. So it's like James Bond when he walks through Q branch. There's people with crazy hair, exploding sandwiches, people using flamethrowers on mannequins. That's very much the vibe, the tax version of that anyway. So they helped me with this, so thank you to them. It applies to qualifying individuals. So qualifying individuals are people who have not been resident under the statutory residence test in the last 10 years. Dual residence is irrelevant, so if you're resident in two jurisdictions and you tie break to that other jurisdiction under a double tax treaty, you are still treated as UK tax resident. Split tax years count as full years. The big winners for this, from this legislation, apart from the Saffery's international tax team, are UK expats. So people have been living in Spain for 10 years, retired to Spain, now in a position, British heritage, now in a position potentially to come back, not pay income tax on overseas income for 4 years, and potentially not pay inheritance tax, as we'll get to in a little bit, for up to 10 years as well. So those elderly British expats, big winners from this. The big losers from this, there's lots of them, but some of them are people who accidentally became resident during the pandemic. If you accidentally became resident here during the pandemic, then you may wish to just tune out for the next 10 minutes while I talk through this, because this won't apply to you. If you're already UK resident and you've got offshore income and gains which you haven't remitted, then we have two sets of rules for you. The excitement of overlapping tax rules, where the old tax rules about remittance apply to your pre-April 25 income, and the FIG regime may or may not apply to your post-April 25 income. So that's twice the work. I could talk for about 2 or 3 hours on this, but I've got about 20 minutes. So overseas workday relief, which is a relief which applies at the moment where you have someone who comes to the UK, salary paid by a UK employer is normally all taxable here, even if your duties are carried out partly abroad. But there's 3 years of overseas workday relief, which says that if your duties are partly in the UK and partly abroad, the overseas bit can be taxed on the remittance basis. So that's being retained. It's being extended to 4 years, positive, to match it with the FIG regime length of 4 years, and there's no need to keep money offshore, which is a significant benefit to lots of people who would otherwise have applied for overseas workday relief, but who need all of their income to support their lifestyle. However, it's now limited to the lower of 300k or 30% of salary. So if you spend 3/4 of your time working abroad, you're still going to be taxed on 70% of your income. Unlike now, which it's 25% of your income. So it's longer, you have more flexibility in what you can do with the money, but it's less generous monetarily. And there's a technical change to PAYE, which says that, because normally you need to write to HMRC and agree to get them to pay a lower rate of PAYE on your earnings, and you can now do that from the start without having to wait for them to get back to you, which is positive. The FIG regime applies to overseas capital gains. So overseas capital gains arising in the first 4 years are not going to be taxable in the UK. That also applies to Section 3 gains. So if you own an asset abroad, an overseas asset through an offshore company, you're taxed when the offshore company makes the disposal, but the FIG regime will apply to that gain. Similarly, it will apply to trust gains and losses. So if you're a settler of an offshore trust, the trust makes a disposal, that's taxed on you. If the disposal is an offshore asset in the first 4 years, also exempt. It also applies to Section 87 gains. So if you're a beneficiary of an offshore trust and you have a distribution during that 4 years, which would otherwise have matched to a capital gain, then again, you're exempt from tax during that period. The sting in the tail there, which Alexandra Britton-Davis and that team tried for about half an hour to get me to understand last night, and I think I understand it now, is that if the gain arose, an offshore trust makes a capital gain during your first 4 years, that gain gets distributed to you, not taxed. However, the gain remains in the pool of gains for the offshore trust. So if you get a distribution after the first 4 years, then it comes back into charge. So there's loads of stuff like that about offshore trusts, which is really techie and hard and can mean that you're taxed in a way that you don't expect. Carried interest gains, we're going to talk about in a little bit, but to the extent those relate to offshore services in the first 4 years, they can be partially exempt. One change from the current position. Currently, if you are non-res and you sell a company that owns UK real estate, you're taxed on that. A non-dom isn't, because the gain is deemed to be an overseas gain. That's going to be changed, so those gains are brought into charge for people during the first 4 years of residence here. There is a rebasing. This is now the third type of tax rebasing we have. So we have, if you're keeping score, 2015 rebasing for non-residents selling UK residential property. We previously then had 2019 rebasing for non-residents selling UK commercial property. And now we have 2017 rebasing, because why not, for non-DOMs selling offshore assets. Like all rebasing rules, it's much more complicated than it needs to be, and there are situations where you won't get it that you think where you were expecting to. For example, if you were non-resident between 2017 and 2025, you won't qualify for rebasing because you must have made a remittance basis claim in that period, and you couldn't have if you were non-UK resident. So it applies to overseas assets. It applies in more limited circumstances than you would like. You can't be non-domiciled or you can't be domiciled or deemed domiciled as at April 25, and the asset must be an offshore asset. But that's summarising sort of 10 pages of legislation, so do check on that one. This is the bit where one of my colleagues wrote too complicated, exclamation mark, exclamation mark, exclamation mark on my draft slides when I asked her to have a look at them, which is a bit of a red flag. So this is how you claim the foreign income and gains exemption. The exemption applies to income, not the person. So it has to be claimed separately for every sort of income and gains that you have. You have to put it in your tax return. If you miss your tax return, you don't file a tax return tough, then you're taxed. If you miss out the source of income, which we don't quite know, I don't quite know what that means, perhaps some people know what that means, but in the good old days when we would do cease the source planning, income from a different bank, like bank interest, was a different source per bank. So we think you might have to list out all of your different sources of offshore income and the amount in your tax return, and if you miss one off, then that's taxable. So the claim process is going to be extremely complicated and difficult, and if there are late revisions to your income, you may not be able to qualify for the exemption. And also a point is if you make a claim as currently for the remittance basis, you lose your personal tax reliefs, your personal allowance and annual exemption for CGT. There's a particular issue on some of my clients who are US taxpayers where they're taxed because the tax year ends are different. So you may not know until quite late what the income is from the US, just because of the way that things like financial year ends for LLPs work and stuff like that. So that's going to be quite challenging for people. There is, as was previously announced, a temporary repatriation facility, although technically, since the money has never been in the UK, it is a patriation facility. This means that for 3 years, beginning April 25, up from 2, we previously thought it was going to be 2 years, there is a lower rate of tax if you bring in pre-2025 income. 12% tax rate for the first 2 years, 15% tax in 27-28. So lots and lots of clients are going to take advantage of that. Lots of clients are going to be taking advantage of that. You don't actually need to remit the income. So you can just give the details. We think this is the way it's going to work. You can give details of the mixed fund or the place where the income is and declare it, pay tax on it, but you don't need to bring it here. So for example, if you've bought a rental property abroad using untaxed offshore income, and you want to pay tax on that income now under the TRF, you can do that, but you don't have to sell the property to bring the money to the UK. So that's, again, that's quite complicated, but will be a very significant benefit where offshore, previously non-domiciled people have significant amounts of offshore income tied up in illiquid assets. So that's going to be quite important. And there are some changes to mixed funds. Business investment relief, which allows people to bring in money to the UK and not pay tax on it as long as it's invested into a business. That's going from April 28, so they want to do a TRF claim in respect of that. Nearly there. Stick with it. Just a couple more slides, I think. So the bit that's really going to upset people is, well, the offshore trust bit, which we're talking about now, and the inheritance tax bit. The other changes, I think, are talking to clients are considered to be unpleasant but just about fair enough, whereas particularly with offshore trusts, clients were told to set these up. This was a policy decision to encourage the protected trusts. They were a thing in the legislation. So there is an element of the feeling of bait and switch here that people have, where they were encouraged to set them up and now they don't work. So protected trusts are no longer effective for foreign income or gains. So if you set up an offshore trust from which you can benefit on or after April, well, if you set it up whenever you set it up, if you're a long-term resident, i.e. you've been here for more than 4 years, after April 25 and income and gains arise to it, they're taxed on you, which is different to now. Non-UK settler or dead, then UK beneficiaries taxed similarly to now. If you've got pre- and post-April 25 income in the trust, the trustees are going to have to undertake quite a painstaking and careful internal accounting process to keep those separate and to keep those measured, because they'll want to make sure that they can distribute the right sort of income to beneficiaries in the UK. One thing which is going to be quite beneficial to clients and quite positive is that the temporary repatriation facility applies to pre-April, to income within a trust, even if the distribution is made between April 25 and April 28. So again, lots of clients, I think, are going to want to take trust distributions or deem there to be trust distributions under the TRF under these rules. Finally, inheritance tax changes. Inheritance tax is currently based on domicile, so if you're non-dom, you're not taxed on overseas assets. If you're UK dom, even if you're non-resident, you're taxed on worldwide assets. Currently, after you've been in the UK 15 years, you're eligible for, liable to inheritance tax on your worldwide assets. That's going to 10 years, with effect from April 25. There is a tail of up to 10 years, so if you leave the UK, you're still liable for UK inheritance tax on worldwide assets for up to 10 years. That was considered to be extremely unfair, and they have listened a little bit. So the tail is shorter, or can be shorter. If you're resident in the UK for 14 years, you can have a 4-year post-residence tail. 17 years, a 7-year post-residence tail. 20 or more, a 10-year tail. We were talking a moment ago about offshore trusts, which people were encouraged to set up. Those are going to fall into the UK inheritance tax net if for an event, once the settlor has been in the UK for 10 years. That's a change. Currently, offshore trusts fall into the UK inheritance tax net if the person is UK dom at the date of settlement. It's going to be changed to the date of the event. So once someone has been in the UK for 10 years, they're going to have to worry about 10-year charges on trusts they've set up. There's no grandfathering on that. There is, however, and this is the only bit of grandfathering there is, gift with reservation grandfathering for settler-interested overseas trusts, which were set up before yesterday. Those are going to be very valuable. There are rules, we think, or I think, probably other people know, which mean you can lose that grandfathering. So it's going to be quite important to identify those trusts and to make sure that you don't accidentally taint them by, for example, moving assets between trusts. There is a trap, which I will illustrate on the next slide. So this is a case study from the HMRC guidance which came out yesterday and perhaps illustrates why I had a very bad day yesterday. So this is not the most complicated example in the guidance. That goes to a lady called Zanti. But this is pretty bad. So Jim creates a settlement with 10 million quid of non-UK assets in November 2024 when he's non-res and non-dom. First point, great planning. Create your offshore trusts before you become UK resident. That will become apparent in a minute. I'll have a drink. He then becomes UK resident 3 years later. And so 10 years after that, 2037, he becomes liable to UK inheritance tax, leaves the UK in 2050. So when he sets the trust up, he's not subject to UK inheritance tax on overseas assets. He's non-dom, but even if it had been set up after April 25, he's non-res, so that's fine. So no entry charge on putting the assets into trust when he sets it up in 2024. First 10-year charge is in 2034. And because that's during his 10 years of not applying of the UK inheritance tax not applying to overseas assets, because he set the trust up before he got here, then that 10-year charge doesn't apply. to the trust because he's not subject to inheritance tax, because whether the trust is subject to inheritance tax depends on whether the settlor is at that moment. So in 2034, he's not subject to inheritance tax. 2044, second 10-year charge, he is subject to inheritance tax, so the trust has to pay 6% on its assets at that time. Because this is one of the many reasons why this is fun, because he's only been subject to UK inheritance tax for 7 years at that stage, 37 to 44, it's a 4.2% inheritance tax charge. 2054, after he's left the UK, 4 years after he's left the UK, there's another 10-year charge for the trust, and because he's subject to UK inheritance tax at that time, the trust has to pay 6% on its assets. So even though he's been out of the UK for 4 years, then in 2060-61, he's been out of the UK for 10 years, and he ceases to be subject to UK inheritance tax. So the trust does at that stage, so there's an exit charge. So even though he left the UK 10 years ago, and it's an offshore trust, the trust has to pay UK inheritance tax at 6%, not 6%, some percent, 4.2% probably, of its assets at the date he leaves the UK. So that exit charge for non-resident people is, well, I was surprised when I saw it. I was talking to Lizzie Murray about it yesterday, and she said, yes, it's obvious that would apply. Okay, it's not obvious to me, but okay. Okay. So anyway, so just bear that in mind. If he's able to benefit from the settlement, because the settlement was created after 30th of October 2024, then it will be a settler interest trust, and it will be a gift of reservation. So if he dies while assets are in the while he's liable to UK inheritance tax, the assets will fall into his estate. So I had a bad day yesterday, as I've said a couple of times, and that's not the hardest example. There's quite a lot going on there, and offshore trust planning and tax planning for inheritance tax planning for internationally mobile individuals going to be super tricky. Enough of that. Let's talk about something else. So capital gains tax rates, something which I've been able to find 3 incidences of Labour ministers, or indeed Rachel Reeves, saying she wouldn't change over the last couple of years. But it did change yesterday. 3 significant changes. Main rate of CGT going from 20 to 24, and the lower rate from 10 to 18. Those are the same as the residential property rates, the rates of tax you pay if you're selling resi property. So the distinction between those 2 rates will go. So there's no special residential property rate now. 18% and 24. That was pretty much expected, I think. Hopefully that's not a surprise to anyone. Business asset disposal relief and investor relief are going from 10% to 18%. Business asset disposal relief is now going to be worth £60,000 per individual in their lifetime. When it was at its peak, it was worth £1 million. It is a fearsomely complicated set of rules, and you know, in business asset disposal relief rules and partnerships, for example, it's so hard, and to see it's worth £60,000 per head, you think, well, would it not be better getting rid of it? But nevertheless, there it is. Investor relief going from 10 to 18, and no grandfathering, and also the investor relief lifetime limit going from 10 million to 1 million. I personally think that's pretty harsh. Investor relief was designed to be an incentive for people to invest in companies. People have made those investments thinking they would get rid of the relief, they would get the relief, and now they won't. So I think the lack of grandfathering on that is pretty rough, actually. There's some anti-forestalling. Broadly, it's the same as they did when they changed business asset relief in 2020, unfortunately. So that means if you have a contract which exchanged pre-budget and completes afterwards, then the default position is that you pay tax on the new higher rate, unfortunately. There is potentially an argument you could run if you can show that the reason for the split exchange and completion was not tax avoidance, then you may be able to get the lower rate. So it sort of depends how HMRC are going to treat those claims, but you should be expecting 24 on those pre-transaction gains. Same with share-for-share exchange. There was a scheme doing the rounds a few years ago, which I didn't see this time, but nevertheless perhaps people did, where you would share-for-share pre-budget, and then if they changed the rate of CGT, you would elect out of the share-for-share exchange rules under 169Q, I think it is, and that doesn't work. The date for capital gains tax is the date of the election, not the date of the transaction. So that's the new rates. Just there they are. Hope everyone's got the slides. Hopefully they can see those. So everything's sort of edging up a little bit. And the trust rate, sorry, is not on that slide. So trusts are going from 20 to 24 on their capital gains. The one at the end is carry, which is here. The headline on carried interest is that Rachel Reeves has apparently listened, and so the rate of carried interest, which is currently, of tax on carried interest capital gains, currently 28, is going to 32. I stole this chart from a briefing put out by McFarlane's last week. Other law firms are available, which says that, which compares the rates of capital gains tax in major jurisdictions. So 32% in the UK, 22.8 in Spain. There they are. You can see the rates. So 32 puts us at the higher end, but not completely out of court for carried interest on a worldwide basis. That is for 1 year, from April 2025. From April 2026, all carried interest will be taxed as trading income. However, with a 72.5% modifier, which gives you 32.6% income tax rate on carried interest, plus NIC, so 34.6 in total, which actually then puts us higher than literally everybody else except for New York for the taxation of carried interest. That only applies to non-ICBI carry, non-income-based carried interest carry. So broadly, carry that you hold for more than, I think it's 4 years, an average holding period, and there's of underlying assets within the fund. There's various rules about what the fund needs to do in order for you to qualify for that lower rate. Otherwise, it's like it currently is, 45 plus NIC. They're going to change those ICBI rules to tighten them up a little bit, so watch this space to see whether things which are currently taxed at 28 might then fall into 47 post-2026. SDLT. We had been told in the Labour Party manifesto that the only change to SDLT they were planning was to increase the rate of tax for non-residents. There's a surcharge which is currently 2, and they put in their manifesto they were going to change it to 4. But like a lot of other things, that fell into the black hole. So we have this, 2 changes from to the rules announced yesterday. One, the higher rate for additional dwellings, which currently adds 3% to the SDLT rate for second homes, or all properties purchased by companies, is going from 3 to 5, so 2% on top of that. It's 6 in Scotland. I can't remember what it is in Wales, but it's not a million miles away from those two other rates. The super rate of SDLT, which is a flat rate for ATED related purchases, which is relatively rare but does happen, is going from 15% to 17%, so 2% on both of those 2 things. If you're non-resident, you have to add 2 on top of that. So the surcharge is 7% for non-residents buying a second home now, or 19% flat rate for non-residents buying an ATED related property, which is pretty chunky. We are currently enjoying a temporary increase in nil rate band and first-time buyer relief. That's due to end in April, and there are no changes, or there's no announcement yesterday that might be extended, so we expect those to revert to what they were. Excitingly, the SDLT calculator has been updated. So this shows, this is a screen grab of the calculator, which shows the purchase of a second home for £4 million by a non-resident individual today. So if you've got any clients completing on such property today, they will be excited to see they'll be paying £671,000 of SDLT, an increase of £80,000 on yesterday. Moving on. Okay, so the other big news, I guess, well, even bigger news in many cases for private clients in the UK is changes to agricultural property and business property relief. So these are reliefs from inheritance tax which apply to, broadly, farmland and to various types of business assets. So unquoted companies, to private trading companies, to farming partnerships, all those sort of things will qualify for APR or BPR. So there are changes coming from April 2026. Currently, those reliefs are uncapped, which means that they are a critical part of high net worth inheritance tax and sort of estate planning for wealthy families and landowners around the UK, that's going to be capped at £1 million. So each individual is going to have a lifetime limit of £1 million of exempt assets, which can qualify for APR and BPR. If your asset would previously have qualified for APR or BPR at 50%, for example, certain kinds of older farming tenancies, I think it applies to assets used in the trade of partnerships but which aren't partnership property, things like that, then that doesn't use up your million. Your million only applies to things which would have qualified at 100%. You can use your million up by passing away with the assets in your estate, by contributing assets to trust and creating a CLT, or a failed pet, i.e. a gift in the 7 years prior to your death. That's when you can use your million, and AIM shares and other shares on which are not on a recognised stock exchange, which currently apply to BPR, it's going to be 50% always for those assets. So, and for trusts, trusts created on or before budget day have £1 million allowance each, and that allowance can be used against 10-year charges, I think exit charges, exit charges, things like that. Trusts which are created on or after budget day will share £1 million exemption. Details for exactly how that will work to be confirmed. So that stops you creating loads and loads of these trusts, each with £1 million of exemption available. How it works, where you've got trusts created before and trusts after, I don't know. Do the trusts created before somehow use up the million for the trusts created afterwards? What about assets transferring between trusts? Don't know, but those details have not yet been published. But each trust before budget day has £1 million, trust afterwards share. There's going to be some anti-forestalling, perhaps not as much as there could have been, for failed pets. So if you make a pet after budget day and you die after 5th of April 2026, but it's a failed pet, then the new rates will apply to that death. So that's quite strange. So there are no changes to the pet 7-year rule, which we were sort of worried there might be. There's no limit on pets, and we were worried there might be a limit on pets. So lifetime gifting and no changes to holdover relief. So lifetime gifting of assets is going to be a huge thing. People are perhaps going to trust their heirs, or have to trust their heirs a little bit more than they otherwise would have, but the standard practice of giving stuff away before you die, so it doesn't fall into your death estate, and it's not a failed pet, seems to be pretty strong. So I think with these sort of rich families, there's going to have to be a significant review of the strategy for passing assets down, but there are still strategies to do with lifetime giving. Likewise, if you're happy to pay a 3% 10-year charge every 10 years, then getting assets into trust before April 2026 is entirely possible. You'll be able to get full, if your asset qualifies for BPR, because after all, Balfour's not changed either. So if your asset qualifies for BPR, you can get it into trust before April 2026 and then pay 3% every 10 years. So I think everyone's going to have to look at their inheritance tax planning, but this doesn't prevent inheritance tax planning. Other IHT changes, and the 325,000 nil rate band and the 175 frozen for another 2 years. I can't even remember the last time those changed. It was so long ago. And the 2 million threshold for taper of estates, so where you start to lose your nil rate band or your resi band, that's staying unchanged until 2030 as well. There's another change for pensions. So if you have an unspent pension that you die before the age of 75, that will now fall into inheritance tax for the first time. I couldn't see anything about what happens after you're 75, because currently there's income tax on such pensions. They're not subject to IHT. No mention of that, so maybe that won't change. Don't know. And then finally, this is a slide I had last time. So this was announced as a new measure this time, but it was definitely in my budget slides from March. So anyway, there's the slide from last time. Currently, APR, there are concerns that APR doesn't apply to land which is set out for things like biodiversity net gain. They're going to extend the rules of APR so it does allow such claims. So there you go. The slide is there, but I won't re-announce it. Business tax. So, right, okay. So, employers' NIC is going from 13.8% to 15% from the 6th of April 2025. And the thing which I didn't really pay much attention to at the time, but have done a lot more since working out what it means for Saffery profits next year, the secondary threshold, at the rate, the threshold at which you start to have to pay employers' NIC is going down by just over £4,000. So that change alone is £615 of extra employers' NIC per employee. Because you've got 4,100 of extra salary, which is subject to employers' NIC, and the rate is 15%, and so there you go. We have just over 1,000 employees at Saffery, so that the starting point, just that, 615 grand of extra NIC, at which point I went home, kicked the cat, and cancelled Christmas. But nevertheless, and I haven't even tried to work out the increase in 13.8 to 15. So that is a very significant rise. It will disproportionately affect companies which have lower paid employees, because as a proportion of their total NIC bill, it will significantly increase it. It was described by one of my colleagues as a poll tax, on the basis it's £615 per person, which I think is perhaps a little bit OTT, but you see where he's coming from. So that is a significant rise in NIC. And this is where we start to talk about tax incidence. So tax incidence is who bears the economic cost of the tax. So even though employers' NIC is levied on employers, there's quite a lot of sort of august literature, or seemingly sort of august literature, as someone who's not qualified to read it, which suggests that up to about 2/3 or 3/4 eventually gets passed on to employees by employers, either paying them less or hiring fewer people. I managed to find a paper written by the IFS a couple of years ago, which summed it all up like that, which, as my algebra tutor said to me, ought to be self-explanatory. So anyway, that's what that means. So anyway, yeah. So just as an example, the employment allowance is for the very small employers is going to be more than doubled, which is very positive for them. So if you're a really small employer, then you will be you'll be potentially better off if you've only got 1 or 2 employees. But just as an example, school with 30 teachers, and the reason I'm saying school is because it will be apparent in a moment. It's £40,000 each, so extra nick might be about 20 grand for a small school. In that example. Other employment tax matters. One very welcome change is that if you employ staff through an umbrella company, the PAYE liability is shifted from the umbrella company to either the recruitment agent who arranged it, or to the end client from April 2026. So that will hopefully prevent people being exploited to the extent that they are by unscrupulous umbrella companies. There is a change to a company car tax avoidance scheme, which is one of those schemes that you think sounds ingenious, but you only hear about it after it's closed, where people were lending money to their employees. The employee would then buy a car, and then they would sell the car back to the employer in due course to repay the loan, which sounds excellent, but now doesn't work. And they're going to be forcing benefit in kind reporting via payroll software from April 2026. All positive changes, potentially. So this is a personal bugbear, just having 3 daughters at private school. So VAT on private school fees is a Labour Party policy. It is something that's been in their manifesto that they're very wedded to. And so, unsurprisingly, it came in and was confirmed yesterday. So we have a few more details as to what it will mean now. So this is going to apply to private school fees for education and vocational training. It also applies to closely related supplies. It won't apply to closely related supplies. So if you've got something which is not education but generally supplied with education, that might still be exempt. So for example, school trips probably won't be subject to VAT. Catering is tricky because HMRC are saying there must be a real choice. So if you have to have school meals, there's going to be VAT on them. If you have a real choice not to have school meals, for example, if your school allows you to bring in a packed lunch, then there may not be VAT on for those who have catering. Most secondary schools I'm aware of don't allow that. But nevertheless, if they do, then there's no VAT on the catering, except for boarding fees, which will be subject to VAT. This applies to payments for education, which is going to take place on or after January 25, and those payments, any payments which are made after 29th of July. So if you did your prepayment pre-29th of July, then it might well work. It applies to nursery fees if there is I think the word is significant number of kids who are of school age. So for example, if you have a private nursery and they have perhaps children with special needs who are held back a couple of years, if there's a significant number of those within the class, then the whole class has to pay VAT on its school fees, whereas if there's an insignificant number of kids in that nursery class, then nobody has to pay VAT on their school fees. So again, that's another headache for private schools who are planning their support for their for those sort of children. Schools are able now to recover VAT on inputs, which is very exciting until you realise that pretty much the biggest cost that schools have is their staff, which doesn't have VAT on it, but will be subject to employers' NIC now, which they'll be higher employers' NIC, which they'll be pleased about. The main VAT recovery that we're seeing from schools' clients at the moment is capital goods scheme for capital projects within the last 10 years. So if any business undertakes a capital project, more than £250,000 of VATable stuff on it, then you can recover the VAT, but over 10 years. So if a school undertook a capital project, say 6 years ago, spent what did I say in my note, £1 million, so that's 200 grand of VAT, they would normally recover 20 grand of VAT a year over 10 years. VAT comes in, well, they wouldn't normally be able to recover the VAT because they're not VAT registered, but now they'll register for VAT, and in this example, there's 4 years left of the CGS unwind, so they'll be able to get 20 grand a year of VAT back. So there's a piece of work for private schools to quantify that and ensure that they're reclaiming the right amount. If you made an advance payment before July 2024, it may qualify, as in it may be VAT exempt, but it depends on the exact terms. So you'd want to ensure that it wasn't refundable, you'd want to ensure that the price of education was fixed, things like that. So not every prepayment scheme will work, but some will. Because parents are not businesses, school is not providing VAT service to a VAT-registered business, so they don't have to issue a VAT invoice. They may want to simplify their VAT reporting, because otherwise the date that VAT applies is the date the payment is made, so you then have to track when the payments are and get them in the right quarter for VAT. Please do note that VAT is due even if the parents are overseas, because VAT is the place of supply is VAT of education is where it's delivered, not where the customer is. If the school provides a bursary, that may be subject to VAT, depending on the structure. If it's an internal bursary that the school offers to children in need, then probably isn't VAT. But if there is a payment made to the school for the education of a specific child, perhaps from a charity or something, then there may be VAT on that. So schools will need to review the structure of their bursaries and speak to someone who knows more about that than me. But yeah, so lots of detail there for schools to cope with. Employee ownership trusts. So employee ownership trusts are something which have been in, the tax legislation has been around for a few years. There was a bit of a slow start while people worked out what they were and whether they wanted to do them, but they've pretty much replaced the MBO as an exit route for private businesses. You have different routes. You have private equity, you have flotation, and you don't really do MBOs now. You tend to do an EOT because they're exempt from capital gains tax. There is an uncapped exemption, so we've seen 8-figure tax savings on EOTs in the past. I'm sure there are bigger ones out there, and so it can be extremely valuable. It's still there, which is great, because clients really like it, and it also the government has historically really liked it because it encourages employee ownership of businesses, which is held to be a good thing. There are some technical amendments which apply from today, or from yesterday, and in particular, the first one. So where someone owns a company, one of the benefits of an EOT for that person might be that they still are in charge really afterwards. Because yes, they have to sell a controlling stake in the business to the employee ownership trust, the effectively kind of EBT, but they can be the trustee, or they can be a director of the trustee company. So they can still be the sort of big cheese in the company afterwards. Well, that's going to change. So you can no longer have de facto direct or indirect control of the trust after the transaction. So that will be off-putting to some people, I'd say. The trustees must be resident in the UK. Most EOTs were, for simplicity, but there was a tax benefit to having an offshore EBT in that a subsequent sale of the business would be exempt from capital gains tax. So that's going away, and the trustees have to be UK resident. The third one, the trustees have to take reasonable steps to ensure that they're not overpaying for the shares. So that is something which they should have been doing anyway, because they have a fiduciary duty to the employees. Their job is to ensure that the employees' interests are looked after, and so they shouldn't be paying massive amounts for shares which aren't worth very much. But in practice, that relied on the employees bringing an action for breach of trust, which I have never seen. And I have seen some fairly punchy EOT valuations. So this will now probably require the trustees to either take their own valuation independently when deciding how much to pay, or ensuring that there's some sort of hold harmless or reliance letter that can be made on that valuation to allow the trustees to rely on it. There's a vendor clawback period going up to 4 years, and you have to provide now information with your claim about the turnover of the company, I think it is, and the number of employees. So the HMRC will be able to sort of triage the claims a bit better and decide what they want to inquire into. There's a new tax exemption for contributions to the EOT by the company being taxed as distributions. This was happening anyway. So if the company makes a contribution to the EOT, which is then used to pay out the former shareholder, you would normally go for clearance, that wasn't a tax avoidance motive. There was no tax avoidance motive to that, and it wasn't therefore a distribution. You now don't need to go to clearance because there's going to be a statutory exemption. I think that's kind of a mistake, because it means that HMRC will not find out about some of these payments to EOTs, but it does speed up the process, takes a month off the time for doing an EOT transaction, reduces costs. And generally, this is not just EOTs, but generally for EBTs, they're tightening up the rules on who can benefit, which will stop some sort of avoidance structures where you set up something which is ostensibly an EBT, and then after you die, it just reverts to a family asset. Those sort of structures probably won't work now, I don't think. So that is helpful. Corporation tax, do stick with it. 10 minutes to go, nearly there. I know it's very warm in here. Thank you for your patience. So we've got, on corporation tax, there isn't actually that much. Perhaps they were so tired after increasing business taxes and personal taxes that they sort of decided they needed a rest. So there's a corporation tax roadmap. There was a cartoon in the Telegraph, I think it was today, which someone shared on the London Tax Partner WhatsApp group earlier, which is a real blast, by the way. It's a real... anyway, it was a matte cartoon, which I think is the Telegraph, and they said, I now no longer think that uncertainty is the worst thing for business, having read the budget documents yesterday. So, which is true, but nevertheless, the corporation tax roadmap is intended to give certainty of treatment on corporation tax for the rest of the budget, the rest of the Parliament. So they're not going to increase the rate of corporation tax, they're not going to get rid of full expensing, they're going to maintain the features of capital allowances, like the £1 million AIA, things like that, structures and buildings allowance to be maintained. They're going to maintain the generosity of the R&D schemes, which I interpret as meaning they're not going to change the rates. There is a staggering amount of fraud in R&D, which has been in the news recently. There are some baby steps to dealing with that. They're going to create a sort of clearance application system where we think how it's going to work is you have to get sort of pre-clearance of your project, but nevertheless, fraud in the R&D market is a concern. But the rates are going to stay the same. The patent box is going to stay the same, and the audio-visual expenditure credit, so film and TV credit, and the video games credit are going to be maintained as well, which is positive. Things which they didn't put in there, and so we think are going to change, there's very little mention about making tax digital. which is due to come in during this Parliament for companies. Still don't have anywhere near enough information about how that's going to work. They're going to be reviewing land remediation relief, which will be a big concern to house builders and landed estates and things like that, because that can be quite beneficial to where you've got to do works on land before you can build on it. And transfer pricing, they're going to reduce the size limits so more companies are caught. So that's going to be increased documentation. Transfer pricing sort of files can be extremely sort of complex and expensive to put together, and more companies are going to need to do that over the next few years. On creative sector CT reliefs, for video effects businesses, the amount that they can get, the amount that you can get back for video effects work is going to increase quite substantially, which is going to be very positive. It's going to cost about 75 million, but an industry body said recently they think it's going to be 2,000 extra jobs, and it's going to be self-funding, which is obviously positive for the sector, which is great. One of those sort of hidden gems, which you don't really spot until far too late in the evening, is loans to participators. So there's going to be changes to the rules, the anti-avoidance rule for loans to participators. This is a corporation tax charge where a close company makes a loan usually to a shareholder. So there is basically, if the loan's not repaid within 9 months of the year end, you have a 33.75% corporation tax charge, which is repaid when the loan is repaid. There's a rule called, which is referred to as bed and breakfasting, which says if you repay the loan and then make a new loan within, I think it's 30 days, that's not treated as a repayment, so you don't get your corporation tax back. Until, I think yesterday, it was possible for the loan repayment to come from another company under common control. So if you repaid one loan using a company under common control, that would get your corporation tax back in company A and start your 9-month in company B. That's not going to work now. It said will likely be caught, which is possibly in the slide there. It's possibly a bit timid. Will be caught, and so for clients who have significant corporate holdings or partnership and corporate holdings, because loans to partnerships from companies are caught as well, where there is not fiscal discipline and independent treasury management on those companies, that's going to be quite significant for those individuals. So they will need to spend more time and effort on their sort of treasury management. And I can immediately think of about 4 clients where that's going to apply. Finally, tax admin. So the government is going to invest in additional tax compliance stuff. It's going to, I think it's 5,000, they were saying, and they're going to raise 2.8 billion a year from in additional tax. Do bear in mind that HMRC said a couple of years ago that the entire tax avoidance budget, i.e. the total amount lost per year due to tax avoidance, is about 1.8 billion. So either they're going to get a load of the error or mistake stuff back, or they're going to double the amount of tax avoidance sort of savings that HMRC say they can make. Every time I stand up in front of you to do a budget presentation, I say there's going to be additional focus on promoters of tax avoidance schemes, and yet there still are tax avoidance schemes, so we'll see if Labour are any better at this than the Conservatives have been. Any agent who deals with HMRC is going to have to be registered from April 2026, which is a positive thing. Digitisation, so we're having Making Tax Digital for IHT. So your big IHT1 handwritten form is going to be replaced by a simple and easy to fill out online form, which is, if ever you have filled in an online form with HMRC, will make you sort of shiver in fear. So that's coming up from April 2027. And finally, high interest child benefit. It was announced, I think, in March that they were going to make it fairer by moving to household income rather than individual income. That's not happening. It's going to stay as it is. But to help taxpayers, the information is going to be pre-populated on their tax returns by HMRC. So that's going to happen, but they didn't say when. So that's it. Thank you very much for attending, and yeah, thanks a lot.